Let me ask you something. What happens when the safest place to park your money stops paying as much? When those high yields on Treasury bills start slipping, who pays the price and who benefits? Welcome to the Money Route, where we turn macro puzzles into investment sense. Today, we tackle a critical question. When Treasury bill rates fall, what does that mean for Nigeria and for investors? And how does it ripple into stocks? First, a refresher for context. A Treasury bill, or T-bill, is a short-term government security, often with tenors ranging from 91 days to 1 year, issued at a discount and redeemed at face value. The yield, or stop rate, is effectively the interest implicit in that discount. In Nigeria, T-bills are a key instrument through which the government mops up liquidity, finances shortfalls, and sets a benchmark for short-term returns. Because they're backed by the government, T-bills are seen as low risk. That makes them a reference point. If yield falls, investors may view them as offering less attractive returns relative to riskier alternatives, equities, corporate debt, real estate, etc. Yields don't move in isolation. They reflect a balance of three broad forces: monetary policy and liquidity. If the central bank pumps cash into the system, short-term rates tend to compress. If it pulls liquidity, yields may rise. Inflation expectations and real returns. If inflation is expected to drop, investors are willing to accept lower nominal yields. Supply/demand dynamics. If the government issues more short-term paper, or if demand, from banks, pension funds, individuals, shifts, yields adjust. Recently, yields on Nigerian T-bills have edged lower across maturities, partly reflecting persistent demand amid tight liquidity. But notice, this is not a dramatic freefall. It's a measured drop. For instance, the 6 November 2025 bill yield eased from 16.63% to 16.60%. Why is this happening? The system is starved of liquidity. Even with demand for safe assets, there isn't much cash circulating to bid more aggressively. Investors might see falling yields as a signal of disinflation or expectations of easing rates ahead. The central bank and government may be calibrating supply and stop rates to manage costs and borrowing burden. Contrast this with past auctions where demand was weak in short tenors, e.g. the 91-day bills got tepid bids, but strong in the longer 1-year tenor. In a prior auction, for example, the 1-year paper grabbed 90% of subscription, and its rate was raised to 16.14%, a 37 basis point hike, amid heavy demand. That tells you investors still chase longer-dated T-bills when returns are compelling. So the recent fall in yield suggests that supply pressures and demand dynamics are balancing in a way that edges yields lower. It's not just numbers on paper. Falling yields carry consequences across Nigeria's economy. Let's break this down. A. Reduced borrowing cost for government, but with limits. Lower yields on T-bills reduce the government's domestic debt servicing burden, all else equal. That frees up fiscal headroom for infrastructure, social spending, or reducing deficits. But caveats: if yields fall too much, foreign investors may pull back seeking higher returns elsewhere, which could put pressure on capital flows and exchange rates. First, icon. The government must balance between borrowing needs and keeping rates attractive enough to get subscriptions. B. Liquidity and monetary transmission. Since T-bills are a tool for mopping up excess liquidity, if yields fall sharply without a contraction in liquidity, the central bank may find itself with less power in monetary control. In other words, if money is loose and yields compress, transmission to the real sector may weaken. Also, in Nigeria, there's a phenomenon of crowding out. When banks and investors channel more funds into government debt, there's less left for private sector credit. Research has found that T-bill issuance and rates have a negative effect on credit to the private sector in Nigeria, i.e., more T-bills or higher T-bill rates can crowd out private lending. So with yields falling, you might think the crowding out effect eases, but that depends on demand and supply responses. C. Inflation, real rates, and consumption. If yields fall because inflation expectations decline, that's good. Real returns, yield minus inflation, may remain stable or even improve. That supports investment and consumption. But if yields fall because monetary policy is loosening while inflation remains sticky, real rates could drop, potentially stoking consumer demand and inflation further, a risk. Now to what many of you care about, your money. How do falling T-bill yields impact different investments, and how should you respond? A. Fixed income/safe assets. If yields fall, the total return prospect from fresh T-bill purchases declines. That makes existing higher-yield T-bills more valuable in secondary markets. So, investors who locked in higher yields may see capital gains if yield curves compress. New entrants get less compensation for risk. That could drive flows away from fixed income toward more productive assets. B. Equities, stock market. This is the interesting pivot. When safe yields drop, equities often benefit, but with caveats. Lower discount rates. In valuations, the discount rate applied to future cash flows is affected by risk-free rates. If T-bill yields fall, the risk-free floor drops, making equities relatively more attractive. Lower cost of capital companies borrow. Lower short-term yields and looser monetary policy reduce borrowing costs, enhancing profitability and future growth. Reallocation of capital. With fixed income less enticing, institutional and retail investors may shift toward dividend-paying equities or growth stocks, seeking higher returns. Analysts expect such shifts in Nigeria, especially into large-cap or high-earning sectors, as yields on government securities fall and risk premia narrow. But it's not guaranteed. Other constraints might slow this. Tight liquidity constraints, banks under capital or reserve pressures, may cull credit growth despite lower yields. If yields fall because macro risks worsen, currency instability, inflation spikes, that can spook equities instead. Empirical evidence in Nigeria is mixed and nonlinear. A 2021 study using a smooth transition autoregressive STAR model found that current T-bill rates had different effects depending on regime. In one regime, current T-bill rate had positive effects, in another, negative. So for you as an investor, falling yields are a green light for equities, especially high-quality companies with growth potential, but you must account for macro risks and liquidity. C. Credit, corporate bonds, financials. Falling T-bill yields can relax rate pressure on corporate issuers. That helps if they wish to roll over short-term debt or issue commercial paper. Banks that borrow short and lend long may benefit from a narrower spread environment. But careful, if yields fall because of distress or credit concerns, risk premia may rise on corporate debt. No scenario is without landmines. If you're going to use yield trends as a signal, here are what to watch and what could go wrong. A. Yield overcorrection and capital flight. If yields fall too aggressively, you may see capital outflows as global investors chase yield elsewhere. That can weaken the Naira, raise inflation, and force policy reversals. B. Inflation surprises and real yields turning negative. If inflation rebounds unexpectedly, real yields, nominal minus inflation, could turn negative, making T-bills unattractive and spooking bond and equity markets. C. Liquidity trap, weak monetary transmission. If banking and credit conditions are tight because of high reserve requirements, weak capital buffers, regulatory constraints, lower yields might not translate into credit expansion. D. Policy U-turns and supply shock. If borrowing pressures intensify, the government might flood T-bill issuance, pushing yields back up. Similarly, external shocks, oil price volatility, forex pressure, could force central bank intervention. All this theory is useful, but here are actionable ideas and guardrails. Things you can do now if you believe T-bill yields will continue downward. Lock in existing higher yield bills. If you hold T-bills at higher yields, consider holding them to maturity or trading them in secondary markets if yields compress. Shift marginal capital toward equities. Increase allocation to quality, dividend-paying stocks or sectors with strong earnings outlooks and manageable leverage. Use a barbell fixed income strategy. Hold both short duration for liquidity and selected longer duration exposure if you believe rates will decline further. The idea is to benefit from rate compression without getting stuck too long. Watch interest rate spreads and policy signals, monitor yield curves, especially 91-day versus 364-day, central bank statements, and monetary policy committee decisions. Have macro hedges. Forex risk may rear its head. Consider diversifying with assets or instruments that provide hedging, FX, gold, or internationally diversified equities, depending on your risk tolerance. Stay nimble. The transition from falling to rising yields may catch many flat-footed. Be ready to reallocate if macro signals reverse. Let's zoom back out. If we see a sustained trend of falling T-bill yields in Nigeria, here's what it could signal over the coming 1 to 3 years. The government can manage its borrowing costs better and free up fiscal space. Monetary policy may lean dovish, lower rates. As inflation comes under control, capital may progressively shift into equities and credit markets. Private credit may expand, especially if crowding out pressures ease. Growth in real sectors could be stimulated by lower-cost capital, but if mismanaged, falling yields could also conceal vulnerabilities: capital flight, forex stress, inflation surprises, or tighter liquidity. For the informed investor, falling yields are not a reason to pan out, but a signal to recalibrate. Look for sectors with strong fundamentals, maintain a healthy dose of caution on macro flips, and don't over-leverage into any one bet. And that's your deep dive on falling T-bill yields in Nigeria, what they mean for the economy, for investors, and for the stock market. Here's a question I want you to comment on. If T-bill yields in Nigeria drop to, say, 13 to 14% in the next year, how would you shift your portfolio? More equities, more bonds, or something else? Let's get the discussion going. If you found this helpful, hit the subscribe button for more insights like this. On Money Route, we don't just talk markets, we give you the compass. See you in the next video.